Hi, this is Vijay Bambwani, and I hope you're doing well in the markets, trading every day or whenever it's needed, and earning good money from the markets. And I've also been able to add value to your knowledge, your skills, and acumen to trade the markets better. Now, in this video, I have a very interesting topic, and as a matter of fact, it's been a request a couple of times in the comment section, and I love when my Fast Profits Daily viewers keep sending me feedback and comments. Hey guys, keep it coming. I'm going to answer as many questions as I possibly can. Now, this is about a new kind of warfare. This is about using the financial markets as a weapon class, and the request was explaining the Dollar Milkshake Theory, which was propagated by Brent Johnson. And the viewers have also asked me what is my take on the Dollar Milkshake Theory, how it will affect the financial markets, their investments, their portfolios, and what should be anticipated. Now, the Dollar Milkshake Theory is nothing but using central bank imbibed liquidity by way of pumping unbacked currency to flood the market with money so that financial markets, the economy, and liquidity does not fall. Now, go back in time a little. If my memory serves me right, it was the finance minister of Brazil in September 2012 signaled that the world was in a state of war, especially currency wars. Now, the wars of the future will not be fought by sending in soldiers into enemy territory using guns and helicopters or jets and warships or submarines. You can basically destabilize a country by weakening its currency, attacking its financial markets, hacking into defense system computers, the banking network, the communication, the transport network, etc. You've all seen Die Hard 4, right? Now, there's a lot of damage that can be done using the cyberspace. Can the same thing be done using financial markets? The answer is yes. We've all seen 9/11, how the terror networks actually went short on the US indices, especially also the airline stocks. And after the World Trade Center buildings collapsed, the Americans went into a state of shock, expectedly so, and airline stocks were the first to take a massive hit. Now, this was using financial markets as a weapon. Now, what the Fed is basically doing is trying to imbibe liquidity into the markets by printing unbacked dollars and at the same time not allowing the dollar to fall in value. Now, in my podcast with Rahul and Sarit a week or 10 days ago, I had mentioned how the US manages its debt as the world's largest debtor nation. It owes a lot of money to a whole lot of countries. So what it does is pay very small amounts of interest, but ensures that the dollar's value keeps rising so that countries that have lent money to the US get a higher dollar value when the money is due for repayment, and therefore they make capital appreciation. Now, this is the difference between return on investment, which is dividend or interest, or return of investment, which means capital plus capital gains. So far, so good. As long as the dollar is rising, inflation in America is under control because whatever it imports is cheaper. The US citizen is happy. Financial markets are happy. The Dow and the Nasdaq keep rising because more and more money is coming in. Now, this is weaponizing the dollar. If you actually go back in time, you will realize that the Southeast Asian financial crisis, I happen to have traded through the Southeast Asian currency crisis, so I know what I'm talking about. It's first hand. Now, in 1997, 1998, countries that had borrowed money from the US in US dollars and they had contracted to pay even the interest in US dollars realized something was terribly wrong, because the US dollar suddenly started jumping up thanks to the US Federal Reserve and a whole lot of other factors. Now, what it simply means is if the dollar went up by 30%, what you owe to the US is suddenly 30% more, because it takes 30% more local currency to buy $1, and you, remember, have to pay back in dollars. Also pay interest in dollars. So your interest as well as principal becomes a whole lot more expensive. Now, what does the dollar milkshake theory state? It states that the US Federal Reserve will continue to print unbacked currency and provide liquidity. Admittedly, there will be times when liquidity will go into excess. At that point in time, there would be deleveraging of the US balance sheet, which means the US Federal Reserve will basically suck liquidity out of the milkshake by using a straw. The straw will be interest rates. They will start to raise interest rates. Now that would basically make money more expensive, more dearer, and therefore people would not want to borrow more, they would actually pay back. Now this is an assumption. As our experience in 1997-1998 Southeast Asian currency crisis tells us, there are many a times when countries have over-leveraged themselves, and when the interest rate starts to go up, or maybe the dollar starts to get more expensive or stronger against the local currency, the countries may simply fold up. They might simply go belly up. Now, you've seen how Mexico almost went to the brink and could not pay its sovereign debt. You saw what happened to Italy in 1997-1998. LTCM bought Italian bonds and almost went bankrupt, holding those bonds all the way down. You saw what happened to other leveraged countries like Malaysia, Indonesia. I could keep going all day, but what I'm saying basically is that the dollar milkshake theory is a part of the modern monetary theory, which says pretty funny things like the new normal. Now, the new normal states that interest rates can be kept artificially low. The new normal says that it's okay to have interest rates which are in the negative, which means I, as a saver, will actually have to pay interest to the bank to hold my money safely. Welcome to the new normal. So, what do I think of the dollar milkshake theory? I think it's mankind's endeavor or an attempt to kind of adapt to changing circumstances, but it seems extremely aggressive. What the dollar milkshake theory will do is that it will create a whole lot of difference between the classes of people. It will make the poor poorer. It will make the capitalist richer. It will make America stronger, because remember, the dollar is being weaponized, and it will make countries that have borrowed money from the Americans a little more poorer. So it'll basically be a little divisive. I'm not saying it's an out and out war out there. I'm saying it's a little divisive. Do I have any views on the dollar theory and dollar milkshake theory and what it will mean to your asset classes? I think paper assets will continue to inflate the way they are inflating due to artificial injections of money, and intermittently there will be huge bouts of volatility, and you'll see declines that you basically may not be able to handle in the near term. But relatively speaking, hard assets, which is metals, real estate, gold, silver, that is, will perform better, although volatility will continue even there. I warn you, don't go into gold and silver as if your life depended on it and throw everything you have in the hat or in the ring, because volatility will not escape even these, will not spare even these asset classes. But relatively, I think you will be better off holding these real assets as compared to paper assets. So the dollar milkshake theory, no matter which way it spans out, is inflationary. It will trigger inflation. It will. Inflation is also known as the misery index. It's supposed to make things more expensive and therefore make people miserable. So the misery index is going to go up, and the dollar in milkshake theory is another reason why I keep saying I would like to make portfolios which bet that human misery is going to go up and human happiness is going to come down. So if you do have any divergent views, if you think the dollar milkshake theory is all good and not bad at all, by all means, it's your call, it's your opinion. But I do feel that unbacked currency is extremely dangerous, and it basically is extremely inflationary. And as an old world trader, inflation is something we've been trained to think of as a negative rather than a positive. So on this note, I'll say goodbye in this video till we meet again in my next. Do take very good care of yourself, your health, your family, and investments and trades. If you're watching this video on YouTube, do let me know what you think of this video and what else you would want me to record in my next. Help me reach out to fellow investors and traders who would like to use a 360-degree worldview on financial markets and knowledge-based investments and trade by referring my video to your family and friends. Do take very good care of yourself. Thank you for watching my video. Bye-bye for now. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.